Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone, and welcome back to our weekly podcast, Through the Noise. My name is Hannah, Portfolio Strategist at the Standard Chartered CIO office, and I will be your host for today. So joining me today is Rajat, our Senior Investment Strategist, to help unpack market events and talk about positioning and where opportunities might lie next. So Rajat, let's start with the big one, the US government shutdown. So the US President Donald Trump had signed legislation to end the longest government shutdown in US history. So what does that mean for markets and what's the implications for investors?
Hi, Hannah. Yes, great to be here. And indeed, the 43-day shutdown has set a new record. Now, overall, the end of the shutdown is positive for risk sentiment, and or should be. But the problem is the data fog is likely to continue for a while, raising market volatility. And this is because key jobs and inflation data for October actually may never be released in full. This raises the risk that the Fed may skip a rate cut in December as policymakers seek more clarity. Any resultant near term rise in US government bond yields would be an opportunity to add to high quality bonds since we expect the Fed to eventually cut rates again to support a cooling job market. Now, to balance the emerging risks from the bond market volatility that I talked about, we maintain a barbell approach towards equities by hedging our exposure to relatively expensive US equities by adding exposure to Asia ex Japan, especially in China, where valuations remain attractive. In the US, we add to the defensive utilities and pharma equity sectors while remaining constructive on the AI fueled high growth technology sector. We also stay bullish on gold due to structural drivers.
So you mentioned that there's the data fog that clouds the near-term outlook. Could you maybe elaborate and discuss the implications for the bond market?
Sure, let's do that. So, investors are trying to assess the impact of the latest shutdown. The US Congressional Budget Office estimates the shutdown could hurt US Q4 GDP growth by almost 1.5 percentage points. Nevertheless, almost half of that is likely to be recouped in the first quarter of next year as workers get back pay and federal programs resume. However, the data fog will continue as October's official inflation and job market numbers may never be reported in full. Adding to the uncertainty, the cross party deal to fund the government lasts until only 30th January. Now, Democrats plan to impose another government shutdown early next year unless the Republicans agree to extend the healthcare subsidies, which expire at the end of the year. Now, what do? We have to look for alternative data, and that alternative data shows the US job market continues to cool. While the stale US jobs data for September is likely to be released next week, we will have to rely on alternative data from the private sector to assess the state of the economy in October. Now, employment components of the ISM PMI data, which is the private sector data, continue to show contraction in both manufacturing and services in October, while the NFIB Small Business Survey for October showed hiring plans fell for the first time since May. Also, labor quality remains the top challenge for businesses. Meanwhile, the weekly initial jobless claims from the states continue to report, mind you. So the weekly jobless claims from the states have risen in recent weeks, but remain within the historical range for this time of the year. So taking all of that together, the limited data set that we have from the private sector has added to the caution amongst Fed policymakers. A growing number of policymakers have expressed over the last 1 week the need to hold rates amid uncertainty about the impact of tariff on inflation. Now, this raises the bar for a rate cut on 10th December. This, in turn, is raising the risk of a further near term upside in US government bond yields. Nevertheless, I should add that we see policymakers ultimately cutting rates to support the cooling job market. Thus, we see any near-term rise in the US 10-year government bond yield towards, let's say, 4.25% as an opportunity to add to high-quality bonds.
Thanks, Rajat. I think earlier on you also talked about adopting a barbell strategy in equities, focusing on US pharma and utility sectors. What are the key takeaways from the earnings season for these particular sectors? Are there any near-term catalysts that we can look out for?
Yeah, the earnings season have been very good actually for these companies. So the US healthcare sector delivered strong Q3 results with almost 93% of the companies in the sector reporting beating consensus earnings estimates compared with 83% for the overall S&P 500 index. The utility sector also delivered strong Q3 results with a beat from 75% of the reporting companies, although this lagged the high bar set by the market. Within US healthcare, we really like the pharma sector where we see receding regulatory headwinds. Investor positioning data suggests that the US pharma sector may be overcrowded for now after a strong run up. However, we believe its 12-month forward PE valuation of around 15 times earnings continues to be attractive, and that compares very favorably with the 23 times forward earnings for the S&P 500 index. The expansion of GLP-1 drugs, availability for government's Medicare and Medicaid programs, and further agreements between the pharma sector and the government would be positive for the sector. Now, about the utility sector, it also trades at an attractive valuation discount with defensive earnings growth boosted by the data center build out as part of the AI investments. Now, data center construction may face supply constraints in the near term, although longer term demand for power remains very positive.
Thanks, Raja. And maybe just a final one on gold. The precious metal has resumed its advance and it now lies at about the 4,200 levels. So, do you think gold can maintain its positive momentum?
Indeed, I think gold has, as you said, resumed its advance after a brief pullback towards the 3,900 per ounce level after this record-breaking run earlier this year. Now we see medium-term upside supported by softer real interest rates, a weaker dollar, and sustained buying from emerging market central banks. With EM central bank gold reserves still relatively low versus developed markets, the case for structural demand growth remains intact. As a result, we maintain our 3 and 12-month price estimates for gold of around 4,300 per ounce for the 3 month and 4,500 ounce for the 12-month, respectively, and would look to add on dips towards whenever gold, if it dips towards the technical support of around 4,000 mark. Now, additionally, we remain opportunistically constructive on the gold mining equity sector as a complementary exposure to leverage on the gold's upside. Gold producers continue to benefit from higher profit margins and surging free cash flows, although investors should remain mindful of the higher volatility and operational risks relative to the metal itself.
Thanks, Raja. I think there is a lot for us to think about and digest, but maybe if I could summarize into three key takeaways. So firstly, that, the end of the record US government shutdown, that should be positive for risk sentiment. But we've talked about how the data fog is likely to continue for a while as key labor market and inflation data for October may never be released. I think secondly, we also talked about for bonds, the team sees any near-term rise in the US 10-year government bond yield towards about 4.25% as an opportunity to add to high-quality bonds. And just lastly, that we can maintain our barbell strategy across both global and US equities. So that's all we have for today. Thank you, Rajat, again. And of course, thank you to all our listeners for joining us today on the Through the Noise podcast. Please do like and subscribe if you enjoyed today's conversation. And we look forward to speaking to you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.